All right, here we're going to look at two spreads, option spreads, stock and option spreads. These are important for your own trading strategies, but they will also be important in future lectures for understanding option pricing, the first steps into option pricing, specifically put-call parity. And they're also very useful for understanding relationships between, no arbitrage relationships between options of different strikes and calls and puts. So option spreads are a really interesting area beyond simple trading strategies. So the first two we're going to talk about is a protective put and a covered call. So the idea of a protective put strategy is, one, we buy the stock. And let's say we buy the stock for $100. So we'll say we bought the stock for $100. And two, then we buy a put option. We buy a put with a strike below the stock, what you paid for the stock. So let's say we buy a put with a strike price equal to $90. And we paid for the put, the premium is, let's just say, $3. So to understand the protective put, we can chart it up here. And the nice thing is, we're going to chart it so we'll see the profit and loss for every underlying stock price. This axis is going to be the underlying stock price. This is going to be dollars, P&L, profit and loss. And it'll also give us an idea of what the max gain, max loss is on this position and where we break even and so forth. So the first thing here is we bought the stock for 100, so we can put 100 here. I'll put it right here, 100. And our P&L on a stock is just going to be a line like that, slope of 1, stock goes up to a 101, we make $1, down to 99, we lose $1. And adding on here, buying a put with a strike at 90, so we can put, this is the strike price, and we paid $3 for it. So the idea here is anywhere above 90, we lose $3 on the option. At 90, the option is going to, below 90, the option is going to be worth more money. Of course, we're going to the option breaks even at 87. So this is what the profit and loss looks like on the option. Now, to get the P&L on any spread, all we have to do is sum the P&L here and sum the profit on the option with the profit on the stock at each point. Keep in mind this is -3. And it's really useful just to start at wherever the kinks are. So here we'll just figure out what the P&L on the protective put position is at 90, where the kink is. Of course, at 90 we lose $10 on the stock. We also lose $3 on the option, so our loss here is 13. So I'll put a dot here. This is -13. Now the idea is below 90 we gain on the put what we lose on the stock. So these two offset each other. So our P&L for the protective put position is just flat below 90. And I'll put a little squiggly line. So this is the combined. This is the protective put position. Now above 90, the option doesn't change. The P&L doesn't change, but the stock does. So this is going to go up along the stock here like this, and we are going to break even here at 103. So this is what the protective put position looks like. So obviously, what we're doing with this position is we're giving up upside in return for protecting us from downside. So that's the idea. Reduce my downside, but then I also have to reduce my upside. Max gain. Our max gain here has no limit. Just say no limit to our gain. Max loss, that's going to be our 13. So here our loss is limited to $13. And we break even. We break even when the underlying, this is of course the stock price at expiration. We break even when the stock price at the expiration of the option is 103. So this is the protective put position. Now, keep in mind, you can without doing this chart, you can always get your max loss by simply saying, okay, well, I'm going to lose until the strike price of the put. So here I'm losing $10, and then I lose the price of the put at 90. So you can always get this by just taking the price at which you buy the stock minus the strike price of the put option plus what you paid for the put option. That's an easy way to get the 13. Of course, we're always going to break even at what we paid for the stock plus the price we paid for the put. So that's the 100 plus the $3 we paid for the put. So the idea of this is, if the stock is below, what is this going to be? This point, which is going to be 87. We are glad we put on the protective put position. Of course, any price above that, we would prefer that we didn't have the protective put position on. So the idea here is, we're going to be worse off in all the states above $87 here, in return for not having to worry at all if the stock, or being happy if the stock falls below 87. Happy that we had the protective put position on. So the next one, so that's protective put, and now we have a covered call, our two basic spread strategies. Our covered call will still buy the stock for 110, but we'll sell a call. And we're usually selling a call for a strike above what we paid. So we'll say we sold a 100. Let's do 110. 110 strike price call option, and of course for this we receive. I'll make up a number, $2. So in this we're paid $2. We'll do the same chart with, and then have max gain, max loss, and break even. So, looking at, we bought the stock for 100, call as a strike of 110. So here we'll put 100, and we'll put the strike price 110 here. P&L on the stock, again, simply line slope of 1. Here we received $2, so the payoff on the call looks like this. The call we sold, it's going to be flat up until 110, and then it's going to decrease there. This is $2, of course, plus $2. Now the combined position, all we have to do is sum at each point. Again, it makes sense to start at the kink. So at 110, we gain $10 on the stock. We gain $2 on the option, and so plus 12. So here we have $12. When the stock is above 110, again, whatever we gain on the stock, we lose on the call. So this is going to be flat off in this point. And then it's going to, because this is flat here, it's going to follow this line all the way down there. And we're going to break even at 98. So we break even at 98. So now the idea here is our max gain, $12. Our max loss, well, the stock can go all the way down to 0, in which case we'll lose $100 on the stock. We'll gain $2 on the call option, so max loss is 98. And then we break even when the underlying stock price is 98. Of course, these two will always be the same. So this protective put, this covered call and all. So this is the covered call position here. The idea of this spread is we're giving away upside to be better in all other states. So the idea is, if the stock goes above 112, we're worse off having put on the covered call. However, if the stock is anything below 112, we are better off for having the covered call position. So again, giving away some upside in return for being better off in all the down states, which is typical. That's what we can do with option spreads. We can gain, we can reduce downside by also reducing what we make in up states and so forth. So it's always a trade-off. Good. The next thing here is to put these two together into a caller. So we can, a caller is going to be buying the stock, selling the call and buying the put. And I'll leave that for another lecture. Good.